Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Eastman Chemical Company Annual Report. Eastman Chemical Company offers a diverse range of businesses and services across various segments. At the core of its operations are the Additives and Functional Products segment, which provides specialty coalescent and solvents, paint additives, heat transfer and aviation fluids, and other solutions for industries such as transportation, personal care, wellness, food, feed, agriculture, building and construction, water treatment, energy, consumables, durables, and electronics. The company's Advanced Materials segment is another key area of focus, offering copolyesters, cellulosic biopolymers, polyvinyl butyryl sheets, polyester films, and window and protective films for use in transportation, durables, electronics, building and construction, medical and pharma, and consumables end markets. The Chemical Intermediate segment provides olefin and acetyl derivatives, ethylene, commodity solvents, primary non-phthalate and phthalate plasticizers, and niche non-phthalate plasticizers for industrial chemicals and processing, building and construction, health and wellness, and food and feed. The Fibers segment offers cellulose acetate tow, triacetin, cellulose acetate flake, acetic acid, and acetic anhydride for use in filtration media, primarily cigarette filters. Natural and solution dyed acetate yarns, and staple fiber for use in consumables and health and wellness markets. Overall, Eastman Chemical Company's business and services span across multiple industries, providing a wide range of products and solutions to meet the needs of various sectors. Eastman Chemical Company, EMN, has experienced a significant drop in its stock price over the past year, exceeding -19.03%. The main reasons for this decline are disappointing financial results and a challenging macroeconomic environment. One major event that led to a substantial decline was when Eastman Chemical's stock plummeted 19% on August 1, 2025. After missing Q2 adjusted earnings expectations and announcing plans to reduce inventory due to weak demand and uncertain U.S. trade policy. This drop was followed by another significant decline on November 4, 2025, when the company reported that its Q3 earnings and sales missed expectations. The stock's performance continued to deteriorate in January 2026, when Eastman Chemical's shares fell after reporting fourth quarter 2025 revenue that missed Wall Street estimates. The Q4 2025 earnings revealed a 12% year-over-year decrease in total revenue and a 67% fall in diluted earnings per share, further impacting the stock price. The cumulative effect of these events has resulted in an annual decline of -26.45% for Eastman Chemical's stock in 2025, driven by lower volumes, price pressure, and general industry weakness. Eastman Chemical Company maintains a market capitalization of $9 billion, broadly in line with the industry peer group. Eastman Chemical Company trades at a higher price-to-earnings ratio of 20 times and a lower price-to-book ratio of 1.58 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 62% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 4.17%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The net income of a company underwent significant changes between 2024 and 2025. The data shows that net income decreased by $431 million, minus 48%, in 2025 compared to 2024, indicating a substantial decline. This decrease was also observed in other metrics, with net income decreasing by $171 million, minus 38%, $317 million, and $433 million from 2024 to 2025. The profit margins of the company also experienced a significant change during this period. The EBIT margin decreased by -38% due to asset impairments, restructuring, and other charges, net. Excluding non-core items, the EBIT margin decreased by -37% due to lower sales volume, higher raw material and energy costs, and lower selling prices. The reasons behind these changes are multifaceted. Inflationary pressures affected operating costs, leading to increased expenses. Market fluctuations and supply chain disruptions resulted in higher raw material and energy costs. Additionally, the company faced lower sales volume and unfavorable product mix across all regions, as well as lower selling prices in the Asia-Pacific region. Furthermore, a higher variable compensation payout also contributed to the decline in net income. Overall, the data suggests that the company's financial performance was impacted by various external factors, including inflationary pressures, market fluctuations, and supply chain disruptions. These challenges resulted in decreased net income and profit margins, highlighting the need for the company to adapt and respond to these changes in order to maintain its financial stability. The company's financial performance indicates a strong ability to generate cash from its core operations. The operating cash flow has been consistently positive over the past 2 years, with figures of $970 million in 2025 and $1,287 million in 2024. This trend is further reinforced by the operating cash flow status being reported as positive on page 69. Additionally, net cash provided by operating activities was also a significant $970 million, as stated on pages 7 and 50. Overall, these indicators suggest that the company is generating positive operating cash flow, which is a key sign of financial health and stability. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, total borrowings had changed significantly, page 41, but subsequent reports showed a decrease in debt levels. Specifically, there was a 4.8% drop from $5,017 million to $4,787 million between 2023 and 2024, page 52. By December 31, 2025, the total borrowings had decreased further to $4.7 billion, page 82. However, when looking at more recent data, there seems to be a slight increase in debt levels. In 2024, the company's debt level was $108 million, which rose to $110 million by 2025, page 93. This minor increase may indicate that the company is taking on slightly more debt. Regarding interest expenses, the trend has been mixed. There was an initial decrease of 2% from 2023 to 2024, followed by a 4% increase from 2024 to 2025, page 60. The net interest expense rose from $200 million in 2024 to $208 million in 2025, representing a 4% increase, page 46. Overall, while there have been fluctuations, the company's debt level and interest expenses do not appear to have changed significantly. The performance of various segments and regions within a company has been mixed, with some areas excelling while others struggled. On the positive side, the advanced materials segment achieved significant milestones, operating the world's largest polyester molecular recycling facility. The fibers segment also performed well due to state-of-the-art production facilities and carbon renewal technology. In addition, several key end markets showed strong performance, including transportation, water treatment, personal care and wellness, building and construction, and consumables. Geographically, North America, Asia, and international markets outside of North America all demonstrated success. However, not all segments and regions fared as well. The additives and functional products segment was impacted by cyclicality in key end products and markets, while the chemical intermediates segment also struggled with similar issues. The advanced interlayers product line saw a decline in sales and EBIT, while the performance films product line faced weak consumer discretionary spending in the automotive end market. It is worth noting that some areas, such as durables and electronics, were not mentioned in terms of success or failure, and information was lacking for regions like Europe and Asia-Pacific finance. Management is emphasizing sustainability and innovation as key drivers of the company's outlook and strategy. They aim to accelerate molecular recycling technologies and reduce absolute Scope 1 and Scope 2 emissions by 30% by 2035. The company plans to achieve significant milestones within its circular economy platform, maintain a strong financial position, and pursue growth initiatives through organic and inorganic means. Eastman is focusing on innovation-driven growth, particularly in the fibers segment, where they aim to be the preferred supplier in targeted markets by providing differentiated value to customers. Management is applying an innovation-driven growth model that leverages scalable technology platforms to provide a competitive advantage and foundation for sustainable earnings growth. The company continues to identify and pursue growth opportunities through organic and inorganic initiatives, aiming to develop a more circular economy through sustainable innovation initiatives. However, management acknowledges the risks associated with inflationary pressures, interest rate increases, and economic uncertainty, but is taking steps to mitigate these risks through pricing actions, risk management tools, and supply chain strategies. Management has sufficient liquidity, with access to a $1.5 billion revolving credit agreement and no outstanding borrowings as of December 31, 2025. They are also employing strategies such as hedging to manage market risks due to changes in foreign currency exchange rates, commodity prices, and interest rates. Overall, the company's strategy is centered around sustainability, innovation, and growth, with a focus on maintaining a strong financial position and mitigating potential risks. Eastman's acquisitions and divestitures overview. Eastman has made significant investments through acquisitions to expand its global presence and product offerings. In China, the company acquired a 60% share in Solutia Thermonol Co., Limited. In Suzhou, a 51% stake in Eastman Specialties Wuhan Yaoji Chemical Co., Limited. In Wuhan, and another 51% share in Kilu Eastman Specialty Chemical, Limited. In Zibo. Additionally, Eastman acquired an 80% share in Eastman Fibers Korea, Limited in Ulsan, Korea. On the other hand, Eastman has also undergone divestitures to optimize its operations and reduce debt. The company closed a solvent-based resins production line, decommissioned certain assets at Performance Films facilities in North America, and repaid $100 million of the 2027 term loan in 2025. Furthermore, Eastman repaid $450 million of 3.8% notes due March 2025, demonstrating its commitment to financial discipline and strategic decision-making. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company declared a cash dividend of $0.84 per share in CONE 2026, with total cash dividends declared in 2025 amounting to $382 million. Additionally, as of December 31, 2025, there were accruals for dividends payable to shareholders totaling $452 million. In terms of share buybacks, the company has authorized a significant repurchase program, with up to $2.5 billion allocated in 2021. The company has made good on this commitment, repurchasing a total of 36,235,096 shares at a cost of $4.2 billion. This demonstrates the company's commitment to returning value to its shareholders through both dividend payments and share buybacks. Concerns about inventory buildup and supply chain disruption are evident throughout the provided text. On page 22, it is mentioned that the company has experienced supply chain challenges impacting its ability to secure raw materials and distribute products timely. This suggests a potential issue with the company's supply chain management. Furthermore, pages 23 and 100 and 20-122 highlight the risk of disruptions due to external factors such as supply chain interruptions or unplanned manufacturing operations. These disruptions could have significant impacts on operations, neighbors, and the environment. Inventory adjustments are also mentioned throughout the text, indicating potential issues with inventory management. Pages 43-44 mention acetate tow, customer inventory destocking, and inventory adjustments related to decommissioning of assets at Performance Films facilities in North America. Page 47 notes a $137 million decrease in inventory due to lower sales volume, while page 48 mentions inventory adjustments related to the closure of a solvent-based resins production line. Additionally, pages 49-50 mention customer inventory destocking and lower sales volume into Europe and Asia due to impacts of tariffs on demand. This suggests that there are concerns about inventory buildup, as mentioned in the sentence, lower working capital, driven by inventory consumption in 2025 compared to build in 2024, on page 50. The LIFO, last in first out, inventory reserve increased in 2025 compared to previous years, as noted on page 126. This indicates potential issues with supply chain or inventory management that may be contributing to the increase in inventory reserves. Overall, these points suggest that there are valid concerns about inventory buildup and supply chain disruption. That concludes the financial summary for Eastman Chemical Company. Feel free to comment below, and I will be happy to answer them when possible.